Okay. Okay, I had a request to go through a video, example of how to work through some of the textbook problems on intercompany transactions. And what I've created here is an example. We're going to start basically with a company acquired at other than book value. Then after working with that for a couple years, we'll go ahead and throw in an intercompany transaction and see how that affects things. So just made up this example. Let's assume that big company bought 70% of little company on January 1st, 2020 for $140,000. The fair value of the non-controlling interest was $60,000. Little's book value was $150,000. Common stock $50,000, retained earnings $100,000. The entire $50,000 of excess value was attributed to property, plant, and equipment with a 5-year life for an annual amortization of $10,000 per year. Each year, Little reports earnings of $50,000 and pays dividends of $10,000. And then a couple years into the problem, Little sells equipment to Big for $50,000. That equipment was originally purchased on January 1st, 16 for $100,000 and was expected to have a 10-year useful life with no salvage value. And of course, we use straight line depreciation just to keep life simple. Okay, so I've set up these T accounts just to sort of keep track of where we are. Here's our investment in Little, with its beginning balance of $140,000, the price we paid. Here is Little's beginning retained earnings of $100,000, and I've created this T account for Little's equity. Now, of course, there's no account called Little's equity. I'm just using that to sort of summarize the common stock plus the retained earnings. So let's go ahead and do our equity method entries first. So what do we have? We have our acquisition. Assume it's a cash purchase. We have our income. Now, we have two things that affect our investment income. First, we get our share of the reported earnings. The reported earnings are $50,000. Our share of that is $35,000. So that increases our investment, and that's our investment income. So 70% of $50,000 is $35,000. We also have the amortization. Again, we've got this amortization of the differential of $10,000 per year. That reduces earnings. So we're going to reduce our investment income by our share of that. So our share of that $10,000 is $7,000. So, and again, I don't want to get too far, into previous material, but basically the idea is that as far as we're concerned, these reported earnings are incorrect, because as far as we're concerned, their equipment is worth more, therefore they should have more depreciation. So, if they're understating their depreciation from our perspective, that means they're overstating their income. When they overstated their income, that means that we, by consequence, overstated our investment income. So basically what we're doing is we're backing out that excess income that was, erroneously reported because they had understated their depreciation expense. And then finally we have our dividends. We get 70% of the $10,000 of dividends. Okay, so let's go ahead and update our T accounts here. The investment Little, we start with 140. We added 35,000. We took away 7,000 for the amortization. We took away $7,000 for the dividends. And I'm not sure why that's in bold. And so our ending balance is $161,000. Let's do the same thing for Little's retained earnings. Little's retained earnings started at $100,000. They reported $50,000 of earnings. They paid out $10,000 in dividends. And so their ending retained earnings, $140,000. Their total equity, again, their common stock was $50,000 there. So their total equity, $50,000 of common stock plus $140,000 retained earnings, is $190,000. So let's go ahead and do our elimination entries, or our consolidation entries. Now occasionally, probably more often than not, I'm going to lapse into calling these elimination entries. The textbook calls them consolidation entries. Same thing. Different people call these entries different things. I'll try to stick with what the textbook does. Consolidation entries First, we have our basic consolidation entry. And again, this one is based on book values. We're going to go ahead and eliminate the subsidiaries' beginning of year owner's equity accounts. And again, their beginning of year retained earnings is $100,000. So there's their beginning of year book value. Now, how was their book value, how was their owner's equity impacted by the events of this year? Well, they paid out dividends, so we're going to go ahead and eliminate dividends declared. I'm going to scooch this down a few lines. We're going to eliminate their dividends declared by 10,000. We're also going to eliminate the investment income and the income to the non-controlling, and we're going to create the income to the non-controlling interest based on book values. Now, again, so leaving aside the question of that excess value for the moment, this basic elimination entry is based entirely on book values. So the book value of reported earnings was $50,000. Our share of that was $35,000. The income to the non-controlling shareholders, what was their share of the reported earnings? Well, again, the reported earnings were $50,000. The non-controlling shareholders get 30% of that, were $15,000. So basically, what have we got here? We've got our beginning of year equity. We've got this year's reported earnings of $50,000 minus this year's dividends of $10,000. If you add this up, that is our end of year subsidiary book value, $190,000. And then we ask ourselves, well, hey, who owns this $190,000? Well, the parent owns the bulk of that. They own 70%, so 70% of $190,000 is $133,000. The non-controlling interest owns the other 30% of that $190,000. So 30% of 190 is $57,000. And of course, God willing, this balances. So just real quickly, yeah, we're all good. Okay, so again, this is based entirely on book values. Now we need to tend to that excess value. Again, we had a $50,000 differential, $50,000 of excess value attributed to property, plant, and equipment. And let's go ahead and assume we don't have a separate accumulated depreciation account. So I'm going to call that property, plant, and equipment net, just to keep life simpler. Now we have to deal with the excess value. And we have two things we have to do. First, we have to go ahead and record the asset that's associated with that excess value. So the excess value, again, what do we have at the end of the year? Well, we had $50,000 at the beginning of the year, but we would have amortized $10,000 of that. So at the end of the year, there's $40,000 of that excess value left. And that excess value is attributed to property, plant, and equipment net. And now again, we ask ourselves, well, who owns, just as we sort of had to ask ourselves who owns this end of year book value, we similarly have to ask ourselves who owns this this additional property, plant, and equipment value. And again, the answer is, well, we own 70% of that. So 70% of 40,000 is 28,000. And the non-controlling shareholders own the other 30%, or 12,000. Again, the textbook refers to this as the excess value reclassification entry. Okay, and then lastly, we have to deal with the amortization of that excess value. Now again, as far as we were concerned, little company is not reporting enough property, plant, and equipment, which means they're not reporting enough depreciation expense. Now, what we've done here is we've adjusted the property, plant, and equipment so it has what we view as the correct value. We need to do the same thing with the depreciation expense. So we say, okay, well, we're going to go ahead and tack on $10,000 of additional depreciation expense. Now, who bears that expense? Well, just as we have here, that expense is borne 70% by the parent, so that's going to affect their investment income for their share. The rest of that goes to the income to the non-controlling interest. Now, again, sorry, I need to put a title on this one. This is the excess value. And now we need to go, okay, and now, again, this is going to be called the amortization of excess value entry. Okay. Again, think of what we've done here. This income of the non-controlling interest. Basically, what we're doing is we're taking and saying, look, of the combined pot of earnings from big and little combined, 15,000 of that is going to be allocated to the non-controlling shareholders. That $15,000 is a deduction on the consolidated income statement. It's an allocation away to these other people. What we're doing here is we're saying, look, Little's reported earnings were too high, which means we allocated too much of that to the non-controlling shareholders. And so basically what this represents here is this represents, in a sense, a removal of part of that allocation, just as this entry here represented a removal of part of the investment income that we had recorded. Okay, let's go ahead and go on to the second year. So here's 2020. Let me go ahead and put a box around this. Format cells, outline. Okay, so there's our first year, 2020. Now let's go ahead and go to 2021, and we're going to do the same thing. We're going to go ahead and do our basic elimination entry. Now, one of the nice things about this process is that once you establish this sort of baseline set of entries, think of how things carry forward to subsequent periods. So again, I'm going to skip our equity method entries for 2021 and just do the consolidation entries. And again, I got to watch what I call these things. Okay, so the basic I'm going to copy this because I am feeling lazy. And just change it as appropriate. Okay, so what do we have to change here? First, I'm going to change my cell widths here. Okay, common stock still $50,000. Retained earnings. Now again, last year's beginning of your retained earnings was $100,000. What happened last year? Well, we started with $100,000. We had $50,000 of earnings. We took away $10,000 in dividends. That got us to an end of year one, beginning of year two balance of $140,000. The investment income and the income of the non-controlling shareholders based upon reported earnings were again $35,000 and $15,000. And again, the dividends declared were $10,000. So again, this represents beginning of year book value plus book value of income minus book value of dividends. So this sum, the sum of this stuff that's highlighted in this box here, this is the subsidiary's end of year book value. So what have we got here? We've got 50 plus 140 plus 35 plus 15 minus 10. We've got $230,000. So who owns, this is the end of year book value. Who owns that end of year book value? Well, again, we own 70% of that. The non-controlling shareholders own the other 30% of that. Okay, now we need to do the excess value reclassification entry. And again, initially the excess value was $50,000 at the start of this process. We were amortizing that at $10,000 per year. So at the end of the first year, it's down to $40,000. Now it's down to $30,000 because again, we're chipping away at that at $30,000 per year. And again, we ask ourselves, who owns that $30,000? Well, we own the parent company shareholders, own 70% of that. The non-controlling shareholders own the other 30% of that. And then finally, we do the amortization of excess value entry, and that's going to be the exact same thing as it was last year. Another $10,000 of depreciation expense, and some more investment income, and you know that is going to be allocated to the parent's investment income and the non-controlling shareholders. So I apologize for stumbling there verbally. I was trying to think of something else while I did that. Okay, so let's go ahead and put a box around this. Okay, so far this is all stuff from previous modules. We haven't yet done an intercompany transaction. Finally, in 2022, we're going to have this intercompany transaction. Now, before we do anything else, let's go ahead and figure out how much of a gain or loss was there on this intercompany transaction. Well, the book value of the asset, it had a cost of $100,000. That was the initial cost. It's being it's being depreciated straight line over 10 years with no salvage. So annual depreciation is $10,000. And it was purchased on January 1st, 16. It's now the end of 2022. So we would have had accumulated depreciation for 2016, 17, 18, 19, 20, 21, and 22. We'd have 7 years of accumulated depreciation. So $70,000 for a book value of $30,000. Now, this was sold for $50,000, and that's going to give me a unpleasant, unround number. So if you don't mind, I'm going to change that to being sold for $60,000. Again, just because this will give us some nice round numbers to work with. Okay, so this property, plant, and equipment has a book value of $30,000. It's sold for $60,000. So there's going to be a gain on sale of $30,000. Okay. Okay, I apologize. I want to change something else here. I hate having two numbers with the same. We're okay on that. Okay, so let's go ahead and do our elimination entries again. Now we're going to have to change things around a little bit. First, let me copy this, because a lot of the stuff is going to be the same, but we're going to have a little bit of stuff that changes. Okay, first we have our basic consolidation entry. And first we're going to start at the same. Common stock still $50,000. Retained earnings now, again, this was 2021's beginning retained earnings. We add $50,000 of income, we take away $10,000 of dividends, and the ending retained earnings is $180,000. So end of 2021, beginning of 2022, retained earnings, $180,000. Dividends declared is still $10,000. It's the investment income that's going to start to give us a little bit of trouble here. The investment income, we're going to compute the investment income based upon not only the reported earnings, but we also need to adjust for the removal of any unrealized gains or losses, or the addition of any realized gains or losses. Now, this is where the date of the intercompany transaction becomes critical. This intercompany transaction took place on December 31st, 2022. So that means that this unrealized gain which we've got, this is going to be recognized starting after 2022. Again, today is the very last day of 2022, so we're not going to recognize any of that gain until the following year. For what we have to do this year is, again, this was not an arm's length transaction, this entity. So we can't recognize gains and losses from what amounts to selling things to ourselves, which is what this boils down to. From a consolidated standpoint, one part of the entity is selling an asset to another part of the same entity and recording a gain. That gain is unrealized. We've got to take it away. And so when we calculate the investment income, this is going to be the parent's share of the reported earnings. This is going to be the parent's share of the reported earnings plus or minus, so it's going to be equals 0.7 times $50,000. That's their share of the reported earnings. Plus or minus any adjustments for their share of any unrealized or realized intercompany gains and losses. So we've got a $30,000 unrealized gain on sale. And then we have two questions we have to ask ourselves every time. First, was this upstream or downstream? If this was downstream, then the parent, and again, downstream means the parent sold to the subsidiary. If this was downstream, then that means that the parent bore 100% of that unrealized gain. Basically, if it was downstream, that means the entire $30,000 gain is on the parent's income statement, and so we have to correct the parent's income statement for the full $30,000. If it's upstream, as it is here, then that means that only 70% in this case of that unrealized gain is on the parent's income statement, and so we have to take away 70% of that unrealized gain. So we're going to go ahead and take away our share of that $30,000 unrealized gain. So 70% of 50,000 is 35,000, 70% of 30,000 is 21,000, or if you prefer, you could do 70% of 20,000. No matter how you slice it, that's $14,000. Now we have to do the same thing for the income to the non-controlling interest. They're going to get their share of the reported earnings. And then we have to look at, I'm sorry. I mentioned there were two questions. Let me do that. I mentioned there were two questions we had to ask ourselves here. The first question, of course, was, is this upstream or downstream? And that dictates whether we take that unrealized gain or loss and split it between the two parties, or whether it all goes to the parent's investment income. This was upstream, so we're going to share it, 70-30 in this case, with the non-controlling interest. The second question is, does the parent use the fully adjusted equity method or the modified or partial equity method? And again, those aren't legislated terms. Different people call them different things. As far as what the textbook refers to as the fully adjusted equity method, some people call it the full equity method, some people call it the fully adjusted equity method, some people call it the complete equity method, some people just call it the equity method. Under the full equity method or the fully adjusted equity method, the parent adjusts their income to remove or add as appropriate any unrealized gains or losses. Under the partial or modified equity method, which is covered in the appendix to the textbook chapters, under the partial or modified equity method, the parent doesn't do that. So basically this part would not be there. We just simply have our share of the reported earnings. The income to the non-controlling interest, again, we have to ask, first they're going to get their share of the reported earnings, so 30% of 50,000. And then we look at these intercompany transactions, and we only have one question for ourselves, and that is, was this upstream or downstream? This intercompany transaction was an upstream transaction. That means that that $30,000 gain, which is on the subsidiary's income statement, was allocated between the parent and the non-controlling interest when they allocated the book value of the earnings. Basically, this $50,000 of income right here, that's overstated. That's not all realized. Just as what we did here is we took that $50,000 of earnings and stripped out the 30 that was unrealized and said, look, only 20,000 of that was realized, so you get $14,000. We're doing the same thing with the income to the non-controlling interest. Say, look, the subsidiary reported earnings of $50,000. 30,000 of that was unrealized, so we're going to take away the share of that unrealized earnings. So the realized subsidiary earnings, 50,000 minus 30,000 is 20,000. So again, you can call that the realized earnings. And the non-controlling shareholders get 30% of that $20,000. Okay, so that's pretty ugly, but we can do it. Okay, finally, the investment in little and the non-controlling interest, we have to make the same sorts of adjustments. Now again, what did we do here? Basically, in 2021, we said, look, here's the entire book value of the subsidiary, and we split that 70-30. We did the same thing here. We said, here's the entire end of year book value of the subsidiary. We split that 70-30. We're going to start with the same idea here. We're going to say, look, the end of year book value common stock plus retained earnings plus the reported earnings is, okay, so now retained earnings, end of year retained earnings is $220,000. So the end of year book value, $220,000 retained earnings plus $50,000 of common stock. So the end of year book value is $270,000. Whoopsie. The investment in little, they're going to get their share of that ending book value, so 0.7 times 270. And then we have to ask ourselves, again, some of that book value was, so some of the book value is comprised of common stock plus retained earnings. Some of that retained earnings is unrealized, and so we have to, just as we backed out the unrealized income out of the investment income and the income to the non-controlling shareholders, we have to back out that same amount from their investment account. So what have we got here? Oops, I want that to be a title instead. What do we do here as far as an adjustment is concerned? Well, we took away 70% of $30,000. We're going to do the exact same thing here. So 70% of 270 minus 70% of 30 is the same as 70% of 240,000. So 0.7 times 240 is 168. Likewise for the income to the non-controlling interest. They're going to get their 30% of that book value. And again, we have to make the same adjustment to the, I should say just non-controlling interest. We're going to make the same adjustment to the non-controlling interest that we made to the income to the non-controlling interest. Here we took away, 30% of 30,000. We're going to take away 30% of 30,000. So, 30% of 270 minus 30% of 30 is the same thing as 30% of 240. So 0.3 times $240,000 is $72,000. Now, at this stage, you might say, well, gee, Dr. Hamley, that seems like a waste of time. Why don't you just take this total and split it 70-30? Because, basically that would work here. The rub is that would work in this case because this was a upstream transaction. Since it was an upstream transaction, basically the book value was split 70-30, the income was split, the reported earnings were split 70-30, the unrealized gain was split 70-30, the dividends were split 70-30, everything was split 70-30. If this had been a downstream transaction, again, if it's downstream, that means that we wouldn't share that unrealized gain between the parent and the non-controlling shareholders. Instead of the unrealized gain of $30,000 being split 70-30, it would go 100% to the parent and nothing to the non-controlling interest. So, much as I like using shortcuts and things of that nature, that simply won't work in this case. Okay, so that was the first sort of stumbling block here. Now let's go ahead, one last thing. In terms of these adjustments, taking away the 30,000 and taking away the 30,000, as I mentioned earlier, it was critical that the sale date was 12/31/22. And the reason that's critical is because we didn't have to recognize any of the gain this year. Again, the gain is going to be recognized over the remaining useful life of the asset. This asset had a 10-year life. 7 years have already elapsed. That means there's 3 years left to go, 2023, 2024, 2025. We're going to recognize that $30,000 gain over the next 3 years, and we're going to recognize that straight line. So $30,000 spread over 3 years, $10,000 per year. So, excuse me. So let's go ahead and finish out this entry. We do have a little bit more we have to add. First, we do our excess value reclassification entry again, and notice what's happening here. The excess value started at 50, at the end of the first year it was down to 40, end of the second year it's down to 30, end of the third year it's down to 20. And again, that gets split 70-30 between the parent's investment and the non-controlling interest. Again, this entry deals strictly with the balance sheet asset, balance sheet investment, balance sheet non-controlling interest. This entry deals strictly with the income statement, expense, income statement, investment income, income statement, income to the non-controlling shareholders, income statement. Now we have one more thing we need to do, and that is we've got this unrealized gain. We sold this equipment, and we need to make it appear as though this equipment was never sold. So again, this from a consolidated standpoint, this transaction never happened. We basically sold something to ourselves and marked it up by $30,000. We've got to make it appear as though this transaction never happened. So basically what we need to do, the little company has on their income statement a $30,000 gain on sale. We need to take away that gain on sale because, again, it doesn't belong in the consolidated income statement. Now, when Little sold this asset, not only did they take the asset off their balance sheet, they also took the accumulated depreciation off their balance sheet. We need to put it back on the balance sheet. Now, I know, let me do this first. That accumulated depreciation back on the balance sheet. Now, accumulated depreciation, of course, is a credit balance account. So we're going to credit accumulated depreciation. That reinstates the accumulated depreciation. Now, something is missing here. What's missing? Well, think of the equipment account. The correct historical cost of the equipment was $100,000. That's what should be reported. That's what would be reported if this equipment had not been sold. It was sold to the parent, and the parent has it on their books at $60,000. Whoops, that doesn't balance. That's obviously $40,000. There we go, much better. The parent has the equipment on their books at $60,000. The true cost, the correct cost, is $100,000. And so basically what we're doing is we're putting the equipment back where it belongs. We're restoring that $40,000 of equipment value, getting it up to its correct level. Okay, let's go ahead and go on one more year. And again, let me put a little box around this to keep everything clear. Okay, I know this is long. We're now up to 30 plus minutes, and if you think it's long for you listening to it, it's also long for me saying it. So, but this is the, I want to be sure everybody gets this, and I think the best way to do it is to, instead of viewing this as a standalone item, it's best to develop this sort of from the beginning. Okay, let's go ahead and see how things look in 2023. Again, a lot of this stuff is going to be the same as it was before. Not all of it, but I'm going to copy that just to save a little time and effort. Okay, what's changed here? Well, retained earnings is now up to $220. That, that basically is going up by $40,000 per year. Reported earnings of $50, dividends of $10, net increase of $40,000 per year. Again, it started at $100, then it went to $140, then it went to $180, now it's up to $220. The investment income and the investment in Little and so on. Now again, dividends declared, that part's the same too. Let's look at the investment income. Now, actually, before we do, sort of 6-1, sort of the chicken or the egg first. Let's look at the investment income first. Okay, the investment income, as always, they're going to get their share of the reported earnings. And now, again, last year, we took away $30,000 saying, hey, this gain is unrealized. Okay, let's go ahead and look at the investment income first. Again, last year, as always, we start with 70% of the reported earnings. And now think about what we did last year. Last year, we deferred a $30,000 gain saying, hey, that gain has not been realized. We're going to realize that over the remaining life of the asset. Again, $30,000 over 3 remaining years, $10,000 per year. And we realize that by adjusting depreciation expense. So basically, think of it as sort of we take it away and then we give it back. We took away $30,000 here, and now we're going to give it back at $10,000 per year. So 70% of $50,000 is their share of the reported earnings, and then we're going to give back 70% of the $10,000. So 70% of 50 plus 70% of 10 is 70% of 60. 7 times 6 is 42. So investment income, $42,000. Likewise with the income to the non-controlling interest. Need to make this a little bit wider, My apologies. Same thing with the income to the non-controlling shareholders. They're going to get their share of the reported earnings. And then, just as we did last time, we say, look, we took away $30,000 last year because it was unrealized, and now we're going to realize $10,000 per year. So we took away 30 last year. We're going to give back 10 this year. So the non-controlling shareholders get their share of the reported earnings plus their share of what's now been realized. So 30% of $60,000 is $18,000. Dividends declared, same as before. Now again, there's no. This is ugly no matter how you slice it. But I think this might be this approach here I'm doing off to the side. This might be the best way to approach it. The ending book value now. Again, book value, you could just look at the subsidiary's balance sheet and say, hey, look, they've got common stock and retained earnings of X and Y dollars, giving you an end-of-year total equity or total book value of Z dollars. In this case, though, basically we know that the book value is rising by $40,000 per year. So the end-of-year book value is now $310,000. That's their retained earnings. End-of-year value $260, plus their $50,000 of common stock. The investment in little is going to be their share of that $310,000. And again, we give them the same adjustment here that we did up here for the investment. Basically, we're giving back 70% of that $10,000. So So 70% of 310 plus 70% of 10 is 70% of 320. So 0.7 times 320 is 224. Same thing for the non-controlling interest. They're going to get their share of the end-of-year book value. Plus, we're going to give back, again, it's the exact same adjustment that we made up here. For the income to the non-controlling shareholders, we had this adjustment of plus 0.3 times 10,000. We're going to do the same thing here, plus 0.3 Sorry about that. Come on. Plus 0.3 of 10,000. Stop it. Anyway, so again, keep in mind, basically we have the exact same adjustments being made here. That is being made here. We have the exact same adjustment being made there. That is being made there. And so their 30% of 280,000 is $84,000. Okay, so again, basically, we adjust the investment income and the income for the non-controlling interest. We make the exact same adjustment to the investment and the non-controlling interest. So same adjustment, plus or minus whatever it was. Last year we added last year we deducted 30,000 from each side. This year we're giving back 10,000 on each side. And it's going to be the same adjustment every year for 2 more years. Every year for 3 years, we're going to recognize $10,000 per year. The excess value reclassification, again, started at 50, then it was 40, then it was 30, then it was 20, now it's down to 10. So we got 1 more year left to go, and that's split, as always, 70-30. And we have another year of excess value amortization. Okay, now we come to this intercompany transaction. Now, last year, we eliminated the gain on sale in the elimination entries. So we don't want to eliminate the gain on sale again this year because there is no gain on sale this year. So we still have to restore the equipment and its accumulated depreciation to its correct value. But the question then is, what do we do with this missing $30,000? Now, again, think of what's happened here. This retained earnings balance of $220,000 up on the basic consolidation entry. That retained earnings balance of $220,000 is wrong. It's inflated. It includes that $30,000 unrealized gain. Because that number is too big, I'm going to go ahead and write too big there. Because that number is too big, their book value is too big, which means that when we did this, these were too big. And so basically what we need to do is cut these things down to size. Again, that $30,000 excess, that's part of the book value. The book value was split 70-30. So because this was an upstream sale, that excessive book value, that excessive gain, that unrealized gain, is included in the subsidiary's retained earnings, which means it was split between both parties. We have to go ahead and take it out. So we're going to go ahead and reduce the investment a little by the parent's share of that $30,000, and we're going to reduce the non-controlling interest by the non-controlling shareholder's share of that $30,000. Okay, so again, what we've done here is we've restored the equipment to its correct value, making it appear as though that sale never took place, and we've fixed the problem that we created up here in this basic consolidation entry. Now we have one more thing that we need to attend to, and that is the actual recognition of the gain. Now, if you think about it, the true or correct depreciation expense, this thing was bought initially for $100,000. It had a 10-year life, so it was being depreciated at the rate of $10,000 per year. That is the correct value. That is the value based on the actual purchase price when it was bought originally back in 2015. When it was sold to Big, or the parent bought it for $60,000, and it had 3 years left to run. So the reported depreciation $60,000 being depreciated over 3 years, the reported depreciation is $20,000 per year. And again, our goal here is to make it appear as though this sale never happened. And part of doing that is to saying, look, the parent is recording too much depreciation expense. We need to undo part of that depreciation expense. And so basically we're going to reverse part of, and again, we're not actually reversing it on the parent's books. We're reversing it in the consolidation entries. We're reversing it on the consolidated income statement. So we're going to go ahead and reduce depreciation expense. Basically, this is just a reversal of part of the depreciation entry that the parent recorded on their books. So this fixes or corrects the depreciation expense. Now, I got one more thing. I know this is already geez, it's almost 48 minutes. I want to just do one more thing just for 2024. Okay, let's go ahead and see what happens in 2024. And I'm gonna skip all this stuff. I just want to focus on this aspect. So think of how things carry forward from one year to the next. Now first, this $30,000, that was the unrealized gain that we were carrying forward from the previous year. We realized or recognized $10,000 of it by reducing depreciation expense. So there's still $20,000 unrealized. So basically that's what's going to be carried forward, and we're going to recognize that. I'm going to copy and paste again. We're going to split that 70-30 between the two parties. The equipment account is still on the parent's books at 60. The correct value, the correct cost is 100, so we have to increase the equipment account by $40,000. Now the problem is this no longer balances. We got 60,000 on the debit side, we got 70,000 on the credit side. Now look at how the accumulated depreciation carries forward. Last year we credited 70, we debited 10, so we're carrying forward 60. And so now it balances. And then we copy this entry again. Okay, now I'm going to go ahead. This was awfully long, and I don't apologize. It's stuff you need to know, and I'm trying to be helpful here. I'll go ahead and save this and post it, and hopefully it helps. Again, if you have any questions at all, please don't hesitate to contact me. More than happy to do anything I can to help. Talk to you later.